Right now, as you're watching this video, your bank is making money off you. Not a little money, a lot of money. And here's the crazy part. They're using your cash to do it. That $5,000 sitting in your savings account, your bank is lending it out at 7%, 10%, sometimes 20% interest. And what do they give you in return? 0.5% if you're lucky. Let me put that in perspective. If you keep $10,000 in a regular savings account for a year, you'll earn about $50 in interest. Meanwhile, the bank lends that same money to someone else and earns $700 to $2,000. You get $50, they get $2,000, using your money. This isn't a bug in the system. This is the system. Today, I'm going to show you exactly how banks turn your hard-earned money into their profits. 24 hours a day, 7 days a week while you sleep. By the end of this video, you'll understand the game. And more importantly, you'll know how to play it smarter. Let's start with the oldest trick in banking. And I mean old, this goes back hundreds of years. When you deposit money into your bank account, you probably think it just sits there in a vault somewhere, waiting for you safe and sound, ready whenever you need it. It doesn't. The moment your paycheck hits your account, the bank takes that money and lends it to someone else. A family buying a house, a student paying for college, a business expanding its operations, a guy buying a car he probably can't afford, and they charge interest on every single loan. This is called fractional reserve banking. Here's how it works. For every $100 you deposit, banks are legally required to keep only about $10 in reserve. The other $90, they lend it out immediately. So when you deposit $10,000, the bank might only keep $1,000 in the vault. The remaining $9,000 starts generating interest income. For them, not you. But here's where it gets really interesting. That $9,000 they lent out, it gets deposited into someone else's bank account. And that bank keeps 10% and lends out the rest. This cycle repeats over and over. Your original $10,000 deposit can create up to $100,000 in total loans across the banking system. Economists call this the money multiplier effect. But lending out your deposits is just the beginning. Credit cards are where banks make obscene amounts of money. This is their golden goose, their cash cow, their money printing machine. Think about it. The average American household carries over $10,000 in credit card debt. And the average credit card interest rate right now, about 24%. 24%. That's higher than most loan shark rates from a few decades ago. Let's do the math together. If you have $10,000 in credit card debt at 24% APR, and you only pay the minimum each month, usually around $200, here's what happens. You'll end up paying over $15,000 in interest alone. On top of your original $10,000, that's $25,000 total for a $10,000 purchase. And it will take you more than 20 years to pay it off. 20 years of monthly payments for something you bought 2 decades ago. But it gets worse. Banks also charge merchants a fee every time you swipe your card, usually 2 to 3% of every transaction. This is called the interchange fee. So when you buy a $100 pair of shoes, the store only gets 97 cents. The bank takes $3 just for processing the payment. The transaction takes milliseconds. They make Americans made over $5 trillion in credit card purchases last year. Even at just 2%, that's $100 billion in transaction fees alone, for doing basically nothing except running a computer network. And here's the brutal truth. Banks love when you don't pay your full balance. They actually have a term for people who pay their credit cards in full every month. They call them deadbeats. Not because they don't pay, but because banks can't make money off them. They want you to carry debt month after month, racking up interest charges that compound daily. Yes, daily. Not monthly, daily. Minimum payments aren't designed to help you get out of debt. They're specifically calculated to keep you in debt for as long as mathematically possible while still looking reasonable on paper. Now let's talk about fees, because this is where banks get really creative. Overdraft fees. You've probably experienced this one. The average overdraft fee is $35. You go $5 negative. Maybe you forgot about a small subscription, and they charge you $35. That's a 700% penalty for a tiny mistake. And if you don't notice right away, multiple transactions can each trigger separate overdraft fees. People have woken up to $200 or $300 in fees for going a few dollars negative. Banks made over $15 billion from overdraft fees last year alone. Billion, with a B. ATM fees. Use an out-of-network ATM and you're paying $3 to $5 just to access your own money. Your bank charges you. The other bank charges you. for pressing a few buttons and getting cash that belongs to you. Monthly maintenance fees. Some banks charge you $10 to $50 per month just for having an account. That's $120 to $180 per year for the privilege of them using your money to make profits. Think about that. You're paying them for the right to let them use your money. Wire transfer fees, $25 to $50 to move your own money electronically. In 2024, when an email is free, paper statement fees, $2 per month because you wanted a physical record of your own transactions. Account closing fees. Some banks actually charge you to leave, like a bad gym membership that won't let you cancel. Foreign transaction fees, 3% on every purchase you make abroad. Just because you crossed a border, these fees seem small individually. $5 here, $10 there. But collectively, American banks made over $30 billion in fees last year. And here's what makes it worse. These fees hit the poorest customers the hardest. The less money you have, the more likely you are to overdraft. The more likely you are to fall below minimum balance requirements. The more likely you are to need exactly the services they charge the most for. It's a system designed to extract maximum profit from the people who can least afford it. But wait, there's more. Big banks don't just lend your money to individuals. They invest it. They gamble with it. Sometimes they gamble big. JPMorgan Chase, Bank of America, Wells Fargo, Citibank. These aren't just banks anymore. They're massive investment firms that happen to offer checking accounts on the side. They use deposits to buy government bonds, corporate securities, and other financial instruments. They trade currencies. They speculate on commodities. They make complex bets using derivatives that most people couldn't understand if they tried. Goldman Sachs made $12 billion in trading revenue in a single year. Not from traditional banking, from trading, from gambling with money in ways that would make a Vegas casino blush. And when their risky bets go wrong, well, you saw what happened in 2008. Banks made insane bets on the housing market. They created complex financial products that even they didn't fully understand. And when it all collapsed, what happened? Banks got bailouts. $700 billion in taxpayer money. Executives kept their bonuses, millions of dollars each. Some got golden parachutes worth tens of millions. And regular people? They lost their homes. They lost their retirement savings. They lost their jobs. 8 million Americans lost their jobs in the financial crisis. The system is designed so that banks keep the profits when things go well, and taxpayers cover the losses when things go badly. Privatized gains, socialized losses. Heads they win, tails you lose. So what can you actually do about this? Here's the good news. You have more options than you think. First, consider credit unions. Credit unions are member-owned, not shareholder-owned. They don't have Wall Street investors demanding maximum profits every quarter. They typically offer higher savings rates, lower loan rates, and fewer fees. The same services, minus the greed. Second, look into high-yield savings accounts at online banks. While traditional banks pay 0.5%, online banks like Ally, Marcus, or SoFi now offer 4-5% interest. That's 10 times more on the same money, doing nothing different. Your $10,000 earning $50 a year at a traditional bank? It could earn $500 at a high-yield account. That's not life-changing money, but it's your money, not theirs. Third, pay off your credit card in full every month. This is the most important rule. If you can't afford to pay cash, you can't afford it. Period. Be the deadbeat the banks hate. Pay your full balance every single month. Never carry a balance. Banks aren't evil. They serve a function in the economy. We need places to store money, and we need systems that provide loans. But they are businesses. Businesses designed to maximize profit above all else. And for most of their history, they've counted on customers who don't understand how the game works. Now you understand. The more you know about how they make money, the less of your money they get to keep. Now you know the game. Play it smarter. If this video opened your eyes, hit subscribe. See you in the next one.